Hello my fellow investors and welcome back to another stock analysis video. Today guys, I would actually like to cover the company 3M. They do have earnings guys on Tuesday before market open, and man, this is a company that I realized I have not done a lot of videos on it. And well, they also have something recently happened to them that is just causing horribleness for them as a company as a whole. So I'd actually like to take a look at their fundamentals guys and see if with this massive crash that they have had, is it a good price to buy it today. So with that said, let's get started with this analysis. But before we get started with the rest of the video guys, I would actually like to go full transparency mode because, well, I don't know, I kind of just like having to show you guys transparency, not just the gains, but I also would like to show the losses as well. And here is my current position guys on the company 3M. I do have money invested in this company, and unfortunately I am down on this. I was originally investing at this company at around like the $160 mark, 155. I did not think it could fall further down from like under 150. At the time, it was very difficult for me to actually see that happen. But then again, I was also very, I guess, novice when it came to this kind of investing. As you can see right here, I am currently down on 3M guys, almost $500. So it is what it is. And the reason for this is actually because of this $100 billion lawsuit that 3M is dealing with right now when it came to earplugs. Apparently guys, they sold earplugs to like combat veterans, and the earplugs did not work. And unfortunately, because they didn't work, a bunch of these veterans got ear damage, they got tinnitus and all this stuff, and now they're facing a $100 billion lawsuit, which is actually causing the share price guys to fall massively, 35.1% on the 1 year and 33.4% on the year to date. You can clearly see the 52-week range is $186.30 to $107.09. So yeah, it's been quite a ride for this company. So now let's actually see if at the current share price of $118, it is actually fair price, because it has fallen massively. So let's actually start off with the main thing as to why people love this company is, for starters, their dividend, 5.1% as of today, which ends up being $1.49 per share, $5.96 in annual dividends, payout ratio of 60%, 5-year CAGR of 5.12 with 63 guys consecutive years of dividend payment. That is something that very rare. They are a dividend king, and this right here is kind of gives hope when it comes to this kind of company, because I mean, guys, 3M is pretty much everywhere, right? They make a bunch of products. They're essentially everywhere. So it kind of is difficult, at least for me, to think that this lawsuit is going to hurt them a lot, right? But apparently it is, and that's causing the share price to come down. Now, ex-dividend date passed as of August 19th. Payout date was September 12th, and of course, they pay their dividends quarterly. Coming now into the calculator, guys, we got the ticker symbol of MMM, market cap of $67.4 billion with a PE of 16.56. So with the current share price of $118.38, this is looking like a pretty good buy. Now, obviously, the lawsuit is a big issue, and of course, we'll take a look at their fundamentals in just one second. Now, with a $5.96 in annual dividends per share, this ends up being $3.4 billion in dividends being paid out every single year, and based off of their average 5-year free cash flow, they're still left with $2.1 billion, and as of last year's free cash flow, it is around $2.5 billion or so. These payout ratios, guys, come out to be 58% for the last year's free cash flow and 61.58% for the 5-year average. So it is a little bit under based off of their last year's free cash flow, and it's slightly above based off of their 5-year average free cash flow. So if this were to just have stayed like this wouldn't be an issue. However, guys, obviously they do have a lot more issues currently that is really hurting them really badly. So for all we know, this dividend may not be that safe. So now let's get started with the fundamentals. Net income 5 years ago of $5 billion to 1 year ago of almost $6 billion, increase of 22%. Now the big issue here, guys, is that we actually did see a little dip here from 4 years ago to 3 years ago. The thing is that COVID happened, well, essentially 2 years ago. And everybody knows, guys, that 3M was just the company to go to, especially when it came to the masks and all that stuff. So for this reason, I'm actually going to give this net income a pretty decent grade of around like 80%, mainly because the 3-year ago value isn't necessarily that easily explained as opposed to if it happened during COVID. Now coming into the free cash flow, we got 5 years ago of $5 billion to 1 year ago of $5.85 billion, increase of 20%. With an average of $5.5 billion. Now we do see a really nice steady increase from 5 to 2 years ago and then a dip 1 year ago. So I'm actually going to give this guy the exact same grade of 80%, mainly because again, the 1 year ago value is not that easily explained as to why it went down. Now coming into the revenue, guys, we got 5 years ago of $31.6 billion to 1 year ago of $35.4 billion, increase of 11.68%. Now the funny thing here is, guys, is that, well, their peak was actually from 5 to 2 years ago, it was at $32.7 billion. And the funny thing is that, well, 2 years ago when COVID happened, you would think that their revenue would just skyrocket, but it actually didn't. Their revenue actually, well, it came up higher than it was 3 years ago, but it wasn't by much, to $32.2 billion, which was a little bit lower than 4 years ago. Now they did make up, guys, this 1 year ago in 2021, but overall this is actually fairly surprising as to why this occurred. So I'm actually going to give this, guys, it's pretty stagnant, you know, it's pretty stagnant, it's not consistently increasing, so I'm actually going to give this essentially like a 70%. Looking at the total assets minus the total liabilities, we got currently $13.8 billion, essentially $14 billion, which is a little bit down from 1 year ago, but this year isn't over, guys, for them. They still have one quarter left, and as you can see here, they actually came down from 5 to 4 years ago, but then ever since 4 years ago, they have been consistently increasing, which is really, really good. Average assets is around $43.2 billion. Average liabilities is $31 billion. And doing this difference, we get $12.2 billion. I'm actually going to give this, guys, essentially like a 75%. Now in the cash flow minus the liabilities department, we could see something very, very interesting. As of 1 year ago, they're at negative $26 billion, which is actually going back down to zero from their lowest point 3 years ago of negative $29 billion. You can see negative 29 billion 3 years ago, negative 27.8 billion, and then 1 year ago, negative 26. Now the issue here, guys, is that they went massively into the negatives when it came from 4 years ago to 3 years ago, but as you can see, they are bringing it back slowly. Average cash flow minus the average liabilities, we get negative $25.3 billion. I'm going to give this, guys, essentially like a 60%. When it comes to the shares outstanding, guys, the metric that people tend to overlook because, well, people just don't really know that it exists. Now for a company that pays out a dividend, it's very, very beneficial for them to be buying back shares, because this also makes it easier for them to issue that dividend on top of just giving you guys a bigger piece of the pie. Now, looking at this, guys, we got 5 years ago of 595 million shares to today, guys, of 569.6 million shares. That's a decrease of 4.25% on the 5 year and 0.38% from the previous or the current year. Now, unfortunately, this is not consistently decreasing. You can see from 3 years ago to 2 years ago, they did increase it slightly by around like 2 million shares, but you could essentially attribute that to COVID. They did buy it back the following year. So for that reason, guys, I'm actually going to give this value a 90%. And lastly, when it comes to the cash and equivalents, they currently hold $2.7 billion with an average of $3.4 billion. Looking at the overall grade, guys, we gave the net income an 80%, free cash flow 80%, revenue 70%, assets minus liabilities 75%, cash flow minus liabilities 60%, and the shares outstanding of 90%, for an overall grade, guys, of 77%. Fairly average for such a major corporation that has lasted for several decades. But now let's actually see, guys, if the current share price of $118.38, it is a good buy today. Now, as I said, guys, I showed you all, I was buying this at 160 and I messed up because it wasn't the fact that I wasn't necessarily looking into this company like this. It was just that I actually wasn't even looking at it at all in this kind of view. I kind of bought this way before I started making these videos in the first place, or even before I even had this calculator. So let's actually take a look at this, guys, now to see if this current share price is actually a good price to buy it at. Coming into the growth tab on Seeking Alpha, we can see that the revenue growth forward is 3.03%, which in my personal opinion is actually fairly accurate, right? I mean, major company is a very difficult for them to grow even further. So I'm actually going to put that, guys, as the median assumption. Let's go to 1% for the low assumption, and let's go to 5% for the highest assumption. Now, for the projected share buyback, they have been doing a little bit more than 4% on the 5-year that we have previously seen. So let's say that for the highest assumption, let's bring it back down a little bit to around like 4%. For the median assumption, let's come down once again to 3%. And for the lowest assumption, let's come down to 2%. Now, guys, we do get some target share prices for this company. And, well, we can see that not adjusting for debt, it is $82.27 for the low one, $89.19 for the median, and $96.60 for the highest assumption. Now, for the target share prices, adjusting for debt, guys, this comes all the way down to $61.69 for the low one, $68.41 for the median, and $75.60 for the highest assumption. Pretty much just telling me, guys, that they have a ton more debt than they do cash on hand, which is the reason why this company's target price is coming down. Now, adding a margin of safety of 5, 10, and 15%. This puts me between the ranges of $52.44 for the lowest assumption, highest margin of safety, to $71.82 for the highest assumption, lowest margin of safety. So, guys, at the current share price of $118, yeah, you guys would still need to wait for this thing to drop. Now, obviously, I made a mistake. You know, I make a mistake. I'm only human. What can I say? So, yeah, I bought this at what, like average share price of like what, 160, 155? Yeah, no wonder I'm down that much. Personally, for me, now that I'm looking at this now, you know, you live and you learn. I'm personally not going to buy any more of this company until it reaches to this point, or at least until that lawsuit gets fixed, right? That's just my personal opinion when it comes to this. But the reason why I'm actually not selling is because of the fact that they're still paying me a pretty solid dividend. So that's essentially why I'm keeping it. Now, obviously, as I just said, guys, this is just based off of my assumptions. All of these values are based off of my assumptions. So I highly suggest and encourage everybody to have this calculator. It is for free. Please make your own assumptions, especially when it comes to a company like this that's going through a bunch of troubles right now, lawsuits and all that stuff. Please make your own assumptions to see where you land at. Maybe you guys think that everything will be fine and, you know, the revenue growth is going to be amazing, right? Maybe you think that $118 is a fair price. That's for you guys to make. So please make your own assumptions. Have this calculator available for free. You can also have my book value calculator, my revaluation calculator, and my dividend tracking sheet, which I showed you guys. I have here 3M. They are paying me at like around $20 for every quarter in dividends. So that's essentially why I'm not getting rid of them so far. If I lose $2,000, then, you know, it is what it is, right? But as it currently stands, guys, that is essentially my analysis when it comes to this. It's fairly decent. It's a fairly decent company. However, based off of my target share prices, you would need for the share price to come down a little bit more. And all I'm asking for a return for giving all of you guys this free things, and of course daily content, is just like, subscribe, comment. It really does help with the algorithm on YouTube, guys. It really does help. So yeah, that's really all I'm asking for. Thank you so much for everybody who have subscribed. I really do appreciate it. So now let's actually take a look at this company's dividend, because massive fall, granted, is telling me that's still not a good price to buy it at today, but let's say that you put in $5,725 at an annual dividend per share of $5.96, guys. This would net you an annual dividends of $288.25, quarterly dividends of $72.06, and a monthly dividend of $24.02. Let's actually bring this price, guys, to this target share price, not adjusting for debt, of around $90 or so. And now the dividends for this, guys, would be $382.56 in annual dividends. So yeah, guys, you will be making bank at this point, assuming that this company falls to that price. So all in all, when it comes to the 3M, guys, as I said, I messed up. You know, it is what it is. I thought that they weren't going to have any problems when it came to their future, when it came to like this lawsuit. I wasn't expecting it, and it happened, and unfortunately I bought at a super massive price, and it is what it is, right? So that's just something to learn about. Now I know to take that into account for the future. However, separating that lawsuit, pretty much their fundamentals are fairly decent, right? Fairly decent. And if they can get this lawsuit under control, you know, they'll probably have to pay out, but maybe it won't be that much. Maybe it won't be $100 billion. You know, they might actually make it out fairly decent. Now, I do have to point out a couple points here. If this lawsuit ends up hurting them a lot more than what we hoped for that to happen, they may cut that dividend or they may issue shares. So take that as you will. And of course, remember that, remember that, please, this is not financial advice. all of this has risks. That's essentially why I advocate everybody to make your own assumptions. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and we'll see you all in the next stock analysis video. And by the way, guys, tomorrow on Tuesday, I'm gonna be putting out a video of just rapid fire earnings reports analysis and a very quick stock analysis on all of these tech companies. So I will see you all then.